So, a lot of people have asked my input on what I think about the 50-year mortgage. Um, I do not think that this is the answer. I think this is a band aid to a bullet hole. Affordability has been made unaffordable because of the inventory, the shortage of homes after the crash. The builders built very low amount of homes compared to how much they build in a decade. And now those people are getting to that age where they are forming households, and now they're looking for housing, and there's a shortage of homes. A 50-year mortgage, when you are talking to someone in your 30s and you're talking to them about a 30-year fixed, they can see, retirement on the horizon, looking at paying off a mortgage. But if you have a 50-year mortgage, mortgages are front loaded with interest anyway. So in the very beginning of a mortgage, you're paying mostly interest. And then as you get further into the loan, you're paying more towards principal. Well, on a 50-year mortgage, you are extending the amount of time. So you are paying more interest up front. So essentially, it feels like you are renting, because when the average buyer's age, first time home buyer's average age right now is 40 years old. So if they take a 50-year mortgage, they're going to be 90 when they pay it off. Now, keep in mind, there are proponents of this 50-year mortgage because the average homeowner in America moves every 8 to 10 years. So if you are not going to be in the home for, 50 years, 30 years, then what does it matter what the term is? Well, it matters because the longer the term, you're paying more in interest up front. And then as you get through the loan, you're paying more principal, less interest. So on a 50-year mortgage, let me give you context. So on a $500,000 mortgage, the payment difference, if the rate was the same, 30-year fixed, the rate would be, let's say that it's 500,000, 6.75. You are going to save an average of $342 a month. That is not going to be life changing. That's not going to entice people. And that's talking about a $500,000 mortgage. If you're looking at a $300,000 mortgage amount, the amount of savings is going to be even less. I will say that the prices for a single, parent or single person living in Atlanta, you almost have to be making, almost a 90 or 100,000 with no other debts to be able to afford, with taxes, insurance, mortgage insurance, all the add-ins that go into the payment. Never mind if it's a condo or a townhome, because then you're going to have an HOA or a condo fee. So to give this context, I really don't think that a 50-year is the answer, because it's not going to bring enough savings, and it's actually pushing the can down the road. Because even if you take a 50-year mortgage and you move in 10 years, you're likely going to want another 50-year mortgage, because unless you're going to step down and buy a much cheaper house, you're honestly not going to want to go up in payment. Most people, might not want to do that. So at the end of the day, adjustable rate mortgages are not the answer. Eliminating the credit score for Fannie Mae, that's not the answer. That's another thing that has been talked about in the last week. Fannie Mae is going to remove the credit scores, the minimum credit scores of 620. What people don't understand is that there are mortgage insurance companies, and there are 7 or 8 that I know of that we work with, and they all have a minimum credit score. So, anybody who's freaking out about the fact that Fannie Mae is removing the credit score minimums to get a loan, just know that mortgage insurance, if you're not putting 20% down, there is mortgage insurance involved. And the mortgage insurance companies do have minimum credit scores. So even if Fannie Mae will accept a 500 credit score, that's not going to work if they don't have more than 20% equity or more than 20% down. There's still more to come with this. We do not know what other requirements there might be. For instance, I believe that this could be helpful for people for cash out refinance or refinance, because in the past, when someone would come to me and they had a 580 credit score, I had no choice, even if they had 50% equity. If they needed to refinance to get savings or cash out, I had to put them into a government loan because Fannie and Freddie would not typically accept a 580. Well, after this change, let's say that you have a 580 credit score and you have a house that you own free and clear and you want to take out a cash out refinance. You're going to be allowed, you're going to be able to go into a Fannie Mae or Freddie Mac, which is a conventional product. You're not going to be forced to pay mortgage insurance. And government loans, FHA, USDA, even if you had 50% equity at the time of refinance, you would still have to pay mortgage insurance. And for FHA, it's 11 years, no matter if you have a 50% LTV. So that's going to be helpful for borrowers who need to cash out, have a good amount of equity. They don't need mortgage insurance. And they just need, to cash out, refinance, and do one loan. They can do it with conventional now. So I see some benefits and I see some drawbacks, but that 50-year mortgage, I do not think that is a good idea. I am all for home ownership. A homeowner has 40 times the wealth of a renter. But if we are going to strap borrowers with a 50-year mortgage and where it's front loaded with interest and you're paying the banks up front, you're paying more interest. And then as you go, you're paying more principal. I don't think that is benefiting anybody. And $340 savings on a $500,000 loan, I don't think that's going to be a deal changer. Taxes, property taxes. I am an advocate for, let's eliminate property taxes. Find a way, do a consumption tax. Eliminate, obviously don't tax essentials and food, but if we went to some kind of flat tax, not flat tax, but a consumption tax, you actually could make people who consume more and buy more luxury goods, they're going to pay more taxes, but give the homeowners relief and make it more advantageous for someone to want to buy a home. Because if you own a primary home, maybe you have no property taxes. Maybe the investors are paying more. And believe me, I'm speaking as an investor. I have an investment home. My first home that I ever bought is actually a rental property for me. So, I don't want to see the taxes go up on on landlords, but something's got to give. It's not going to be adjustable rate mortgages. It's not going to be a 50-year, and it's not going to be doing anything, crazy. I think if they could ease up on assumptions and make loans easier to assume. 70% of the homeowners that have a mortgage in this country are below 5%. So imagine if there was a way, now with government loans, they are assumable, but there are some caveats. The buyer has to qualify, depends on, if it's a if it's a VA loan, the caveat is that eligibility is tied up for the veteran if they let you assume that loan. So it's not always advantageous for everybody. But if they made conventional loans assumable and made it easier for a buyer to assume the loan right now for the seller to get those homes moving, there's also a caveat. So if someone owes $200,000 but their house is worth $500,000, there's a $3,000 shortfall. A $300,000 shortfall that you have to cover. So also the ability to gap the difference between an assumption and the price. A lot of second mortgage lenders will do assumption financing, but they'll only go to 90%, and maybe it only with a 720 credit score. So there's a lot of areas where we could improve, but I don't think it's the 50-year mortgage. So there is my 2 cents, and thanks for coming to my TED Talk.